What's up guys, John here. What you're about to learn today could save you thousands and it can help you make some money too. If you're wondering exactly how a rate cut is gonna affect your mortgage, your savings, or your overall financial health, stick around. I'll walk you through the relationship between Fed policies and your personal finance. Let's jump in. Before we get started, let's set the stage straight. The Federal Reserve, also known as the Fed, is like the brain behind the operation. It is the brain of America's money supply. When they adjust interest rate, which is called the federal fund rates, they are essentially influencing how much the banks pay when they borrow money. When the Fed raises interest rates, borrowing gets more expensive. It costs more for the bank to access more money. And as a result, because of this, the bank also increases their interest rate, causing the borrower to pay even more in interest on their respective loans. Auto loans, mortgages, credit card, and so on. So as you can imagine, this tends to slow down the economy as people realize that things are getting more expensive. So people start spending less, which as a result lowers inflation. Now, the opposite is also true. When they lower the interest rates, as the Fed did in the last month, they want to encourage borrowing and spending, hoping to boost the economy again. And here's the kicker. This isn't just about Wall Street or the banks. It also hits your personal wallet directly and indirectly. And I'm gonna show you how. Now here's where it gets interesting. A rate cut means that bank can borrow money cheaply. That typically leads to lower interest rate on things like your mortgage, your credit card, your auto loans, and even business loans. But here's the kicker that most people don't realize. 1. Borrowing costs can stimulate economy activity. When you borrow or invest, the economy grows. But this also means that companies and governments can borrow heavily, which could add back to inflation. And that's the first thing we wanted to stay away. Prices of everyday things becoming more and more expensive for you and me. 2. For savers, the rate cuts means you're earning less on your interest. The earnings from your high yield savings account, your certificate of deposits, or your bond yields will drop as interest rates go down. So while borrowing is getting cheaper, your savings may earn you less, squeezing your income from your savings. As a side note, when interest rates are low, it's best to seek alternative investment options that could give you a greater return than you would if you kept your money in the bank account. 3. This creates a direct tug-of-war between borrowers and savers, and depending on your personal financial situation, whether you're trying to pay off debt or trying to grow your savings, it can feel like a roller coaster sometimes. Now let's go even deeper. The Fed's rate cut doesn't just set your mortgages and savings rate. It influences inflation, job growth, and stock prices, your investments too. So here's the play-by-play. When rates drop, lenders often pass those savings to you in the form of lower monthly payments. It sounds great, but you have to take the initiatives and request a refinance. Do it before the rates start rising again and inflation ends up creeping up. The same thing applies to credit cards when the rates fall. Variable interest rates on credit card and personal loans usually follow. So save money monthly by paying off your debt as fast as possible. And in some cases, you may be able to renegotiate some terms. Lower interest rates means safer cash options like savings accounts earn less. So some folks decide to move their money from a savings account to dividend-paying stocks or bonds or alternative investments that pay a better return. Now, the big picture. Lower interest rate can boost the stock market short term in many ways. 1. Since companies can borrow now cheaply, more access to money means more investment opportunities. And this is when you see more mergers, acquisition, and increased spending in research and development, which tend to give them a good return on investments. 2. This also applies to retail investor who chooses to leverage to maximize potential profit. Leverage is a term used to describe professional investors that rely on borrowed money to invest. As you can imagine, this comes with a lot of risk. And if this goes south, you're pretty much screwed. 3. Savers also jump into the action by becoming investors as they realize that they could earn more by shifting to stocks rather than keeping their money in the bank account with a low paying interest. Overall, all this could trigger inflation again, and this is why it's so challenging for the Federal to figure out whether to increase or lower the overall interest rates. Here are some concrete data. Since the current rate cut, the average 30-year fixed mortgage has dropped by 0.25%, saving homeowners hundreds on monthly payments. Historically, every 1% rate cut has led to about 10% rise in stock prices within the following 6 months, as I've explained previously why. It is important to note that during past rate cuts, inflation didn't always stay in check. Sometimes rate cuts can cause prices to jump amongst life essentials. So that's when price of everyday stuff like food, rent, fuel rises faster, eroding your savings along the way. It is a balancing act, an economic tightrope, and understanding this will help you make smarter moves with your cash. Refinance your high debt interest now. The window is now open, so you might as well, and your future self will thank you. Review your saving strategy. As I mentioned previously, don't let your cash just sit down in a bank account when the Fed keep dropping rates. Consider bonds, dividend ETFs, or other income-producing assets that offer greater return than letting it sit in a bank account. Invest wisely, but cautiously. Lower interest rates can boost the market, but be sure your investments are aligned with your risk tolerance and long-term goals. Don't risk it all just to make a quick buck. Build your financial safety net. An emergency fund of 3 to 6 months expense is your best defense against volatility. And most importantly, stay informed. Follow trusted sources like the Fed's announcements, economic forums, and reports, but don't panic. Think long-term and don't overreact over short-term news. Think long-term like Warren Buffett. Ignore the noise. So here's what I want you to walk away with. The Fed's rate cut isn't just a headline, it's a signal. It's an opportunity for you to review, adjust, and position yourself financially. Remember, knowledge is power, and your actions today can set you up for a stronger tomorrow. If this gave you clarity, smash that like button, share it with friends that need to hear this, and subscribe. I would really appreciate it. And more importantly, comment below on how you're planning to adapt your finances. And I mean, seriously, I'd love to hear your feedback. Till next time.